Good afternoon or good morning, good evening, wherever you may be listening from. My name is Henry Kent. This webinar today is in partnership with Internations. We'll go into sort of myself and Holborn Assets in a bit more a little bit later. But today what we're going to do is we're going to focus on how to optimize your investments and save taxes as a Portuguese resident, whether that's while you're under NHR at the moment or planning for the end of that. We're going to run through various investment options that are available to us being here in Portugal while investing, but more importantly, that planning aspect for the end of the NHR when we're going to be in a whole new tax regime. So I'll get us started. I'm yeah, perfect. I thought we had a bit of an issue there. So I'll jump in first and then I'll introduce Peter, who's also joined me on the webinar today. But my name is Henry Kent. I'm one of the senior financial planners here at Holborn Assets. I'm a fully qualified financial advisor under the Central Bank of Ireland, which allows me to give regulated financial advice to individuals and clients across the EU. Joined here by Peter. Peter, hi there. How are you doing?
Good, Henry. Thank you. Yep. How are you?
I'm very well, thank you very well. Just give a brief introduction if you like, and then I can get started on the webinar.
Yeah, lovely. Well, as Henry said, I'm Peter Giles. I'm a partner and investment manager at LGT Wealth Management here in London. Just so you know what I do and how it all works, and to understand the process. I mean, Henry and Holborn are the financial advisors that would be your points of contact, structuring your, obviously Henry will come onto this and structuring your assets, etc., in the most appropriate way. And then once they're in place, myself and LGT would be brought in, to manage the investment side. So my whole job is to build bespoke investment portfolios tailored specifically to each client and based around their underlying currency, attitude to risk, overall objectives. So we build, as I said, bespoke portfolios. It's not an off-the-shelf product, and it is very much tailored to each individual.
Yeah, definitely. No, it's fantastic working with you, and obviously that individual advice to each and every one of our clients is a great service and a great option to have. So thank you for that, Peter. What I'll do is I'll jump in and then pass the microphone back over to you a little bit later. So you're able to cover a few bits. So just off the back of Peter's comments, an introduction to Holborn Assets. For anyone who is attending the webinar who aren't aware of who Holborn are, we are a global financial advisory. We specialize in providing cross-border financial advice to individuals and clients actually all around the world. And that's via our 19 international offices. However, myself and my team, we specialize in Portugal, and also in Spain as well. We're multi-award winning. We were established over 25 years ago, and we've got a 5-star Trustpilot review, which I advise for anyone sort of attending today to take a look on there to get insights into what clients who are working with myself, but also us as a company, are saying. We are one of the largest financial advisories here in Europe. We've got in excess of $4 billion assets under management. So that does essentially give us sort of buying power for our clients when working with investment providers for better services, and also a reduction in fees as you're treated as a sort of institutional investor rather than a retail investor. But myself, I'm also based here in Portugal. I'm speaking today from the Algarve, where we have an office in Albufeira. I've been based here for 2 years now. Previously, I was living in Spain for 7 years, where we also have an office in Malaga. So I've been through it, I've lived it, I've experienced exactly what everyone here is going through and been through as well. So yeah, any questions on that? Feel free to drop them into the Q&A box. That goes without saying as well that throughout the webinar, if there's any areas that you want to sort of clarify or further information on, drop it in there, and then we've got a Q&A section at the end where we'll go through everything together. So let's get started. I'd like to start this off with a bit of a stat. Some of you may have already seen this as well because it's been quite heavily promoted, especially on Portugal News and other sort of sites. But a recent survey showed that over 1,000 expats are unprepared for the end of the NHR period. This means that the majority of NHR holders have not sort of considered or planned for what that means, because as we know, NHR is a very favourable tax regime, but everything's going to completely change when we come to the end of that period. I've got NHR as well, that's why I say we, but we're going to cover it today. But with sufficient planning, you can, if you're early, reduce your taxes by 60% on any investments and assets further down the line. And we'll cover how to do that as we come on. So let's jump in. We'll start with investing as an expat in Portugal. I recently wrote an article about this, which you'll be able to find online or on my personal website. But I've gone through this recently. I thought this would be very relevant to cover. So as British nationals or expats living in Portugal, when you first move to Portugal, if you have existing structures back home, whether that's TFSAs for Canadians, ISAs for UK nationals, and other highly tax efficient structures in your country that you used to reside in, when you move to Portugal, they no longer hold their tax benefits that they once had. Okay, there are still sort of some benefits that can continue if you have NHR, but most or more than likely they will lose their sort of benefits. And it's not the end, because there are European equivalents, which we'll cover today, that still hold very good tax benefits. But for anyone with sort of investments or these type of accounts back in their home country, it's best to review them, take a look, see how they're taxed, see how they will be taxed at the NHR as well, and see whether or not there are alternatives that do offer a lot more tax benefits than maybe what they're offering at the moment. So we'll start with high street banks. I banked with Novo Banco, and they've been reaching out to me to look at their in-house products of various funds and ETFs that they seem to offer. I took a look at them out of curiosity, and I found that the strategies that they offer, they're convenient because it's through the app that I have with them, but they're limited to their own in-house funds. This sort of made me look into and find that obviously they're only euro operating, but more so if you look at the underlying costs and the strategies that are available, they usually have higher fees, and investment strategies are very much limited. So although on the face of it, it does look very good, when you sort of break it down and look into their strategies that they have, they're very, very limited from the type of investment strategies that I prefer as an expat being here in Portugal. But also everything's conducted in Portuguese, so it wasn't too easy or simplified for that side of things. Then we've got direct held stocks and shares, which are accessible globally, and they can be very good because they can offer higher returns. But the downsides is they require constant active management. Okay, previously, if you've been in the Magnificent Seven, you would have been doing very, very well. But up until the beginning of this year, or maybe February, you would have taken a significant downturn on the value of them investments. So, yeah, my philosophy and the key to all investment strategies that I believe in personally is diversification. So directly held stocks and shares is not sort of the best strategy that I feel is out there. Tax reporting is also quite difficult and complex in Portugal, having this type of strategy. A fund or ETF type strategy is much more preferred, as it offers that level of diversification, whether that's through asset class or geographically as well. So you can reduce your risk down while still having access to great returns. Yeah, the downside of that is they're generally interest and dividends from funds and ETFs are generally taxed at 28%, and then capital gains are also taxed at 28%. So if, let's say, you wanted to change your strategy and you wanted to sell up and then move into let's say, a lower risk or a higher risk strategy, every time you sell them funds, that's going to trigger a taxable event, which will cause you to have to pay capital gains, which there are alternative structures, which means that you can defer them taxes, buy and sell within a certain structure, which means that there aren't any of these sort of taxable events. Then fourth, we have pension structures. These often include sort of self-invested personal pensions. From a UK perspective, some people may have previously transferred their pension to a QROPS, which is a qualified recognised overseas pension scheme that a lot of people are wanting to explore at the moment due to the new rules brought in by Rachel Reeves and the UK government about pensions now forming the estate for inheritance tax. People are trying to strategize and find ways to get out of that. However, QROPS has really sort of been put a stop to. There was a recent announcement in the budget that meant if you weren't transferring your pension to a QROPS that's basically you reside in, then there's an overseas transfer charge. It doesn't mean that it's completely out of the picture, but it means that a lot more planning, tax planning and advice is required to make sure it's suited and available and not going to cause any significant charges or tax liabilities. So these are all fantastic. They've all got their pros and they've all got their cons. However, there's one strategy that is what I believe, in my personal opinion, the best strategy available for expats in Portugal. And this is a term that you may or may have not come across before, but it's called the Portuguese Compliant Investment Bond, PCIB, or Portuguese investment bond, life assurance wrapper. There's various names that these type of structures have, but this is without doubt the most tax efficient structure that is suited to expatriates here in Portugal. These type of wrappers or investments are usually held in highly regulated and secure jurisdictions, so outside of Portugal, but still part of the European Union, with jurisdictions like Ireland, Dublin, and Luxembourg for some non-English speaking clients. The reason why they're highly tax efficient, and I'll go through that. Essentially, the longer you hold these bonds or this investment from the date that's set up, the reduction in taxes that you will see over time. So you can see here that if you're within your sort of first 2 years of NHR and you've got investments that are sitting away that's going to provide an income for you maybe later on, or you're wanting to grow your wealth, if you invest within the first 2 years, you'll find that when you're at the end of your NHR period, that's when your taxes are going to go to the progressive normal rates of tax in Portugal. You would have held your investment for more than 8 years. And you can see here from this table that the normal tax rate is 28%, which in the first 5 years, if income is taken out, then is taxed at any normal rate of any investment. But if you've held it for longer than 5 years or less than 8 years, then you get a 20% reduction, which reduces that real effective rate down to 22.4. And then for more than 8 years, that 28% is reduced by 60% to 11.2%. So that's the effective sort of tax benefits. But the structure itself, it's essentially similar to a wrapper, which I've touched on, but a nicer. You can have any investment strategy within that bond or portfolio, as long as it's European compliant. And you can buy and sell within that bond that doesn't trigger any sort of tax liabilities or taxable events. It's essentially only when income is taken out of that investment is tax payable, and that's tax payable proportionate on the gain element. So you're never taxed on the initial capital that's gone in. It's only on the gain element. And as you can see, that's reduced over a period of time. It's portable as well. So if, let's say, you're in Portugal, but there's plans that you could potentially return back to the UK, it's completely internationally portable. Unlike if you're investing onshore in Portugal, it's likely you may have to surrender and shut down that investment, which will trigger taxable events. But being portable, it can move on with you if you were to go back to the UK or elsewhere, while still providing significant tax benefits should you decide to. Because it's outside of Portugal, also being held in either Ireland or Luxembourg, there's no Portuguese taxation. Also, for anyone here that's been out of the UK for a considerable amount of time, when the new rules change from an inheritance tax perspective on a residency basis rather than domiciled, there are ways potentially to mitigate and reduce your UK liability as well. So lots and lots of benefits. Planning is required, but this is a fantastic option for any expats out there who are wanting to plan for the end of their NHR and ways to reduce their taxes down. If you have strategies at the moment and you want to assess whether or not you're able to replicate that strategy within this type of bond just to get your taxes down, then we can explore that and talk through it. But Peter will jump through the investment strategies and the options and the tailored portfolios that LGT have to offer. But essentially, within this bond, all strategies available: equities, bonds, ETFs, funds. As long as they're European compliant, you can hold them within this wrapper, and you can have tailored portfolios that are adjusted to your risk levels, all the way from conservative up to aggressive. Although there are sort of time period reduction in taxes, it is completely flexible. It doesn't mean that your funds are tied up for any period of time. You do have access from day one, but it just means that the longer the funds are held within there, the less tax is payable. So it's flexible from a withdrawal side of things, so regular income, but also additional funding as well. And also it's multi-currency. So being in Ireland or Luxembourg, you're able to hold sterling, US dollar, euros. You're not reliant on one currency. A lot of information I've just thrown at you there. So what I'll do is I'll go through a bit of a case study on this type of investment, just so you've got an understanding of how it works. And then I'll pass the microphone over. But essentially, if you were to look at this type of investment, let's say for conversation purposes, you invested 100,000 in year 2 of your NHR. After 8 years, when you come out of your NHR period, you're back at progressive rates of tax. The investment has grown, let's say, just by round figures by 50%, and the current valuation is 150,000. Because you're out of your NHR period, your taxes have jumped up, and it means that you've got a shortfall from income to outgoings, which you require for your living expenses. You could look at this as to make up that shortfall. And this is how it would work. So for an investment of 100,000 that's grown to 150, if after the 8th year you want to start taking an annual withdrawal of 15,000, the investment provider will establish how much of that 15,000 is initial capital and how much is gain. That would then be paid out, and the calculation would be done by the investment provider. And obviously you've been holding the investment for longer than 8 years, so you've got a 60% reduction, which is an effective rate of tax of 11.2%. That's withheld and paid to the authorities on your behalf. So it makes administration, taxation as simplified as possible, while getting a significant reduction in your taxes. That's quite a vanilla or basic sort of case study, but it gives you a sort of rough idea as to how it works. But also, another advantage of this type of structure that not a lot of people know about is if you're considering downsizing property in Portugal, there is reinvestment relief. So it means that if you were to reinvest the proceeds of the property sale, you would get a tax exemption on the capital gains if the proceeds are reinvested into a new property or in a long-term pension plan, which the Portuguese compliant bond satisfies. And I've helped clients save thousands and thousands of euros with this exact strategy by downsizing and reinvesting, and they then are able to take out income while completely mitigating and reducing their capital gains tax on the property sale. It is important to note that you must be retired and over 65 years of age to benefit from this exemption. And if you're going to do it, it has to be done within 6 months of the property sale. I've had one or two clients miss out because of that deadline. So it's important to plan and speak with either myself or a qualified financial advisor to understand the suitability and make sure that it's an option and a way to do so early on the process. So I've given you a bit of detail there. If you have any questions on the Portuguese compliance investment bond, feel free to reach out on the Q&A, or feel free to reach out to me and book a meeting in after, which I'll include a QR code to book into my diary. But I've been talking for quite a while now, Peter. I'm going to pass over to you and let you introduce yourself and also LGT, if you don't mind.
Lovely. Thank you very much, Henry. So yeah, good evening again, everyone, and thank you for your time. So just kind of to bring all of that together a little bit, LGT, we've been working with Holborn for a number of years now, so we've got an excellent relationship, number of mutual clients, and we find it just works really well as a combined offering in reality for clients. So just to kind of so you fully understand the process, if this is something you're interested in and you want to find out a little bit more about it, Henry will always be your point of contact. He'll be the guy that you reach out to understand a bit more about it. And then if you want to go down the route of the Portuguese compliant bond, it would put that in place for you. And then at that point is where myself and LGT can come in. So we can then take over and help you manage the assets within the Portuguese compliant bond. But it's very much a three-way process. So to fully understand it, you as the client would always be at the very center of it. You've got Henry on one side providing all of the financial planning advice, and myself and my team on the other providing the investment advice and the investment strategy solutions. So Henry's flipped onto the first slide. So I don't know if you know much about LGT, if any of you have ever heard of them. You'd be forgiven for not, but actually when you look into it, LGT is actually the largest family-owned private bank in the world. So it's owned by the princely family of Liechtenstein, which is effectively the royal family of Liechtenstein, and it's been held in the family for around about 100 years now. So it's a very old, historic private bank. I think the good thing about that ownership is that it will always be held by the family. It will always be owned by the family. It's never going to be floated on the stock market. It's never going to be sold to private equity or another wealth management company. It is very much the kind of the jewel in the crown of the Liechtenstein economy, and will continue to be held by the family for many years to come. So I always find that gives clients a lot of kind of reassurance, just to know that they're not just going to get flogged to someone else in the industry and have to up sticks and move to a new firm. So just moving on to the next slide, just to give you a bit more detail on the group and where we're based. You can see the blue shaded areas. So that's where LGT have offices around the world. So we're in about 30 different locations globally. So here in the UK, we used to be a company called Vestra Wealth. We got bought by LGT in 2016 and merged into the business. And we run about £34 billion worth of client assets in the UK. We've got 750 staff and about 7 offices across the UK. So we're very much one of the big 10 wealth management companies in the UK. But the wider group gives us obviously a global presence. So as I said, headquartered in Liechtenstein, we've got big offices in Switzerland, Austria, Germany, and then across the Middle East. So UAE, across to China, Thailand, Japan. We bought a company in Australia about 3-4 years ago called Creestone, which we've now amalgamated into the wider group. And we can also look after US connected clients, which is something Henry's done with our group many a time over the last few years. But we can look after US connected clients again via our office here in London. So we've got a specialist team that look after US connected clients. So globally, we're running north of £300 billion worth of client assets with over 5,500 staff. So as I said, very much one of the big global wealth management private bank companies. The next slide, I think this is just here really just to give you a bit of reassurance just around the stability of the group ultimately. It's A plus rated by Standard and Poor's, so that means that we have, the regulators have deemed us to have a very stable credit rating. We are obviously have a good balance sheet. The table in the bottom left hand corner is quite interesting. This is something called a Tier 1 ratio. Now, you may not know what that is, but it was brought in after the financial crisis in 2008, whereby it was deemed that all banks had to have at least 10% of their total assets on the balance sheet held in cash and short-term bonds, meaning that if there were to be another financial crisis, that those banks should be able to withstand any kind of liquidity crunches, etc. Now, if you can see the chart, I know it's quite small, but LGT has a Tier 1 ratio of 19.5%. So it's basically twice the minimum requirement, and it's actually higher than all of our peers. So it's a very strong, stable balance sheet. And equally, we do not have an investment banking arm, which means that we don't have any leverage, which ultimately what happened in 2008 and then maybe with Credit Suisse going bust in 2 or 3 years ago, that could never happen to us. Ultimately, it's a very, very secure business. So just to kind of provide a bit of peace of mind around that. The next slide, I think, is really kind of the crux of who we are and how we operate. I think ultimately service is absolutely everything in this industry. It's a very emotive issue when we are looking after our clients' wealth that they've spent their whole lifetime building up and saving. It's a very emotive issue to then hand that over to someone else to manage it for them. So we are very cognizant of that, and it's as a result, the service is the most important thing as far as we're concerned. I think if you don't have good service levels in this industry, you don't really have much of an offering. So I work alongside a guy called Andy Gaskell. We run a book of clients, total assets of about 350 million between us. Then we're supported by Adam, who's our trainee investment manager, and then Haley and Jack are our admin team. And so they do a lot of the day-to-day kind of payments and account opening, etc., online access, all that type of thing. The point is that you have direct contact details for all of us. You'd have our phone numbers, our email addresses. You can WhatsApp. We can jump on Teams calls whenever you like. Ultimately, we need to be visible for you, and we are there as much or as little as you need us. As I said, it's not a call center approach. You don't ring up a number and get someone different. You will always speak to the team that understand your objectives, your needs, and your portfolio. So I think that's just absolutely crucial in terms of how we operate as a business, ultimately. The next slide just delves a little bit more into how it works, the services that we offer, etc. So on the left-hand side here, you've got portfolio management. This is what I do. So I said at the very top that my job is to build bespoke investment portfolios. Now that can be done on a discretionary, advisory, or execution-only basis, depending on your preference and the amount of control ultimately you like to still have over the portfolio. But as I said, we do build it entirely from scratch once we understand your objectives and what you're looking to achieve. If you have particular ESG preferences, we can build an entirely sustainable portfolio for you to make sure we're investing in ESG funds and making sure we're meeting those objectives. And we also have the opportunity to invest in alternative investments. So that would be things like hedge funds, absolute return funds, if so desired, that we can facilitate for you. Now, the next box, obviously, we work alongside your financial advisor. In this case, it would obviously be Henry. Henry puts all of the financial planning structures in place for you, and then we obviously work in conjunction with Henry and yourselves to then build the investment portfolios. International client services, something I mentioned briefly earlier. Generally, it's focused on our kind of US connected clients. If you're a US passport holder, for example, you would come under that category. And as I already mentioned, we can cater for that. And then the last box, specialist services. We're able to do some additional things like Lombard lending, which is whereby you can use your investment portfolio as collateral to obtain a loan, for example. So you can borrow against your portfolio and do whatever you like with it, buy a property, invest into a business, etc. And then we can build private markets portfolios, that type of thing. So there's lots of options ultimately, and in reality, there's no type of investment portfolio that we can't manage or assist you with. The next slide, I just wanted to delve a little bit into our investment process and how it all works. So just so you know that it's not just myself that would be picking stocks, bonds, funds, etc., to go into your portfolio. There's obviously a much more rigorous process behind the scenes. So at the top, we have our investment committee. They are chaired by our chief investment officer, a guy called Sanjay Rijsinghani, who's been with us 20 years or more, highly experienced. And the whole job of the investment committee is they meet monthly and they're looking at the world from a top-down macroeconomic perspective and determining what's going on in the world, and obviously particularly relevant at the moment with what's been happening with the tariffs over in the US. financial markets have been all over the place, be it bonds, equities, gold, whatever asset class you look at. They've been incredibly volatile in the last 3 months in particular. So the investment committee will look at all of the factors that are happening on a global basis and determine how much we think we should have in bonds, how much we should have in equities, how much we should have in gold, cash, etc., for our low, medium and high risk portfolios. So they provide a framework, if you like, of an exposure. Within that, it's then how much should we have in the US, how much should we have in Europe, UK, Japan, China, etc. And so building up our portfolios and just making sure that we are taking advantage of the opportunities that we can see in the world and responding to what's happening. And, you know, for example, we reduced our US exposure at the beginning of the year with what was happening and the impending 2nd of April announcements, which obviously Liberation Day, which didn't really go how anyone would have liked. But we've actually now been adding back a little bit into the US as it kind of has sold off significantly. So it's things like that, just making sure we're very active and position our portfolios where they need to be. So once we've developed that framework of the total exposure that we want to have in different asset classes, we then have various subcommittees who are doing the research ultimately. So our equity committee are analysing individual stocks, individual equities. Henry touched upon these earlier, how you can hold them within the Portuguese compliant bond. Our equity committee will look at it's generally US, European and UK equities with a handful of Asian stocks as well. But we have an approved list of around 70 stocks across those geographical regions. And you know, obviously we are only interested in high quality businesses that are growing their earnings, strong balance sheets, strong management teams, etc. The fixed income committee next to that is our bonds committee. So we have an approved list of high quality corporate bonds and obviously government bonds. So that'd be US treasuries, European government bonds, ECB bonds, German bonds, etc. And also UK gilts here. The authorised collectives committee is one of the most important ones. There's probably 10,000 funds that you can invest in, many of which are pretty terrible and you wouldn't want to go anywhere near. So our approved collectives committee, authorised collectives committee, are screening that entire universe of funds and ultimately looking at the volatility measures, the outperformance in up markets, how well they protect your capital in down markets, etc. And then narrowing that list of funds down to what we think are the best 120, 130 funds across all geographical regions and all asset classes. And so the point being that when we then come to construct a portfolio, you can be confident that we've done the appropriate due diligence on all the asset classes and all the different options to invest in the hopes that we are putting the best options for you into your portfolio. Now, my job as an investment manager is to obviously sit down with yourself as a client and Henry as an advisor and understand exactly what the objectives are, what the attitude to risk is, and what the long-term plans are. And I will then use the tools available in these approved lists of stocks, bonds, funds, etc., to then build you your bespoke portfolio tailored for you, if that all makes sense. As I say, any questions on all of this, please just fire it into the Q&A as you're going along. The next slide, again, just drilling down a little bit into the risk profiles, just to give you an idea of how a portfolio might look depending on what your attitude to risk is. Now, low risk at the bottom, if we look on the right-hand side of this bar chart, low risk is at the bottom there. Now, that's obviously people who are just not comfortable with any volatility whatsoever. They're maybe used to cash savings, etc., in their lifetime and are just not prepared to take a significant equity risk in their portfolio. So a low risk portfolio would have a high exposure to bonds and other lower risk assets. You're looking at about a 75% exposure to bonds within that, and then maybe just 20% in equities. So a fairly low equity weighting. So what that means in times like we've seen in the last 3 months, obviously this type of portfolio will hold up well. Government bonds, particularly shorter duration ones, held up fantastically well over this period. Longer duration, kind of 15, 20-year duration bonds were a bit volatile as everyone suddenly got a little bit concerned, particularly in the US, about the outlook for the US economy. But ultimately, the bond element has done very well, and obviously having a lower equity exposure will mean that the portfolio held up better. As you then move up through the risk boundaries, low, medium, high, and these are all internal boundaries that our risk team set us. So we have maximum allocations that we can put into equities and bonds for the various levels of risk, and this would be something that you would determine at the account opening stage in what you're prepared to accept. But we would obviously talk you through all of that. But you move up to the top end of the spectrum and you get to high risk, and ultimately you're up to 100% in equities ultimately at this point. Now, what you're going to see with that is a much more volatile portfolio. However, you have also got the chance of generating better long-term returns. You know, if you look at the S&P 500 over the last 20 years, it's annualized about 14%. That would obviously be great. You'd take that over a 20-year period of time. However, that doesn't look into the nuts and bolts of the annualized moves that you would see in that. And it's not for everybody to have that level of risk. So this is the important stuff that we have to determine at the outset when we build a portfolio for you. And then beyond that, we've just got to, I just wanted to put a couple of example portfolios in, really. I mean, these are, as I said, very much an example. They're just the type of thing we've put in place for a couple of our European-based clients who are investing in euros. I think it's important to stress, actually, also that we can invest in any major currency. So I've done euros here purely because this is a webinar aimed at generally Portuguese-based expats who I imagine a lot of your assets will be in euros, but we do dollar portfolios, sterling. Obviously, I've got a number of Swiss franc portfolios that we've put together. So ultimately, we can find solutions for you in any currency. But what we've got here is a euro portfolio. We've based it on a million euros, but that number is actually irrelevant. You know, the important thing is the weighting that we put into each holding and each asset class. Medium risk portfolio here, we've got about 67% in equities, the remainder in bonds and cash, the majority in bonds. Within that, so if we take the bond element first, we've got a number of German bunds at the top, and then a mixture of actively managed bond funds and then passive ETFs within that space. The reason we do the blended approach of active and passive, two main reasons really. Just to highlight, just to give you a high-level view of what an actively managed fund is, it's a fund where there is a fund manager who is responsible for investing all of the funds that roll into that fund. So if we buy units in an actively managed fund, the fund manager then utilizes that capital to buy securities, so that be that bonds or equities in the country or the asset class in which they're operating, with the objective of beating the benchmark in that country. Now, those actively managed funds, generally, because these are companies that obviously they need to make their own money, they need to be profitable, actively managed funds will generally have a higher fee. If you look at the second column to the right-hand side, it says TER, percentage. That stands for total expense ratio, and that equates to the underlying cost of these funds. So these aren't charges that we would levy as a management fee, but these are the underlying cost of funds. So you need to be aware what you're paying ultimately for the investment portfolio and what it would cost. And so those actively managed funds, as I said, will have a higher fee because there is a manager in charge and a team of analysts that are actively choosing bonds or equities to try and beat their benchmarks. Now, this is the point of our research teams that I mentioned earlier, and why we are screening all of these funds. There is no point buying an active fund that is consistently underperforming its passive benchmark because you're paying a fee for absolutely nothing. So this is why we screen the funds and ensure that we are buying the best actively managed funds, that we are confident if we hold these for a period of time, you will beat the benchmark on which they are based. So that the active funds are in there to generate what we call alpha. So that's outperformance against the benchmark, but equally they are less volatile. So in down markets, they will hold up better. They will give you less volatility than a passive ETF, but equally they will also be a bit narrower in their focus. So if we actually focus on the equity side now, let's talk about the US. An actively managed fund in the US may have 40 to 80 stocks within it, so, or maybe even fewer than that, but they are not going to have the whole exposure to the S&P 500, for example. Now, what we've seen over the previous 2 or 3 years, and Henry touched upon the Magnificent Seven earlier. Excuse me, sorry. My daughter's just played music in the background. It came through. I do apologise. But what we've got in the US is that you're not going to have full exposure to the S&P 500. So as Henry mentioned, the Magnificent Seven stocks did so well for such a period of time. Well, actually, active funds really underperformed for 2 or 3 years because they're just never going to have the same exposure. About 35% of the S&P 500 is made up of just 7 companies. So you're never going to have that exposure in an actively managed fund. So you do need to have the passives in there as well to ensure that when you get a period that's driven by those companies, your portfolio has the ability to benefit from it. But equally, as we've seen this year, as Henry mentioned earlier, those stocks have significantly underperformed for the last 5 months. And therefore, you want the active funds that are investing into the other areas of the market to give you that performance. And what that enables you to do is to smooth out the performance over the long term and give you steadier returns rather than these big swings that you would get if you just invest in the S&P 500. equally, so it's about protecting on the downside with lower volatility for the active funds. It's about ensuring that when you get that high concentration on the way up, we've got the passives to benefit from that. But equally, it enables us to manage the underlying cost of the portfolio. So, as I said, the passive funds, passive ETFs are a lot cheaper. And by having the blended approach in each region, by having the best active sat alongside the passive benchmark, it means that we can control the costs, and that benefits the clients quite significantly. Yeah. So that's kind of a feel for how we construct the portfolio. The next slide, we don't necessarily need to go into in more detail. It's just a higher risk exposure. It's a lot of the same name, but what you'll see is that you just have a higher equity weighting and a lower fixed income bond weighting ultimately. That's broadly it from me. It's a high level overview. I've kind of whistled through it, but any questions, obviously, please send them through.
Yeah, I'd just like to say what makes LGT stand out. We, as an advisory, we are completely independent, so we do have access to the full investment market. But from working with various investment managers, I can say that LGT offer the best levels of communication to all of our clients. If there are sort of things going on behind the scenes, buying and selling, market sort of volatility, Peter and his team are out there speaking with my clients and keeping them updated on what they're doing behind the scenes to limit that sort of volatility and what the strategy is moving forward. So customer service, but also performance as well, is been historically much better than a lot of investment managers and providers out there. So this is why we love to work with LGT, and we'll continue to do so moving forward. But yeah, thank you, Peter, for that. That was really informative and helpful. What I'll do is if anyone wants to sort of reach out to me, has any questions about their assets, they've just moved to Portugal, you're in Portugal, you're planning for the end of your NHR, you want to sit down and talk through about your investment strategies or planning for the future, feel free to scan the QR code that's on the screen now, and you can book straight into my my diary through Calendly. Or if you want to sort of request a complimentary tax guide that we have for new residents here in Portugal, I can offer that as well. But for anyone that has specific questions to their circumstances, I'd recommend just booking in a meeting through that QR code or on my email address. We can sit down, we can have a no obligation conversation just to see whether or not our services are going to be of any relevance or benefit to your particular situation. Just got one or two questions that have come through, which I'll cover, and then we'll wrap this up. We'll be sending out a recording to everyone who has attended, but also who has registered in the past as well. So that will be sent out. So I'll just cover that and then get that sent on. So first one, what if you're a new resident under the D7 visa? Does the same apply using the Portuguese compliance? Yeah. So anyone is eligible as long as it's suited and as long as it's been reviewed and it's suited for your individual circumstances from a regulated financial advisor. Then yes, the Portuguese compliant bond is available to anyone under any visa. It is important to mention that due to the complexity of US connected clients, having the dual taxation and FATCA legislation, the Portuguese compliance investment bond is not usually suited to US nationals, but for all other nationalities, the Portuguese compliance investment bond is available, and no matter what visa you're under. Could you please give us an indicator of management fees, please? Do you cater to non-NHRs? Of course, we cater to all expats here in Portugal, no matter whether you're under NHR or not. If you're not under NHR, even more so to work with ourselves or speak with us to establish what can be done to reduce your taxes and liabilities down here in Portugal. An indicator of management fees. So the fees vary. The fees depend on assets under management, which are being looked after, the complexity of the advice, and any sort of preferences or requirements that you may have for your individual circumstances. So we don't have a set fee structure. It is dependent on your individual circumstances. But what I would recommend is scanning the QR code, reaching out to me. We can have a discussion. And if after that discussion we feel that our services are potentially relevant or benefit to you, then what I'll do is I'll go away and I'll put together my advice in an email format to then send over to you so we can then sit down on our next meeting to then run through it together. And that will include all fees associated with any advice or strategy that is recommended to you. So, if the Portuguese compliant bond is not good for US persons, what is the best tax benefit package? So, because of the complexities with US connected clients, there are still options out there and available, but it's not as straightforward and simple as the Portuguese compliance investment bond. But there are ways to manage your investments that are more efficient to Portugal. There are considerations to be taken in as well. Certain sort of holdings are not sort of tax optimized for Portugal, for US connected clients. But also, aside from that, is if you're not a DIY investor and you have a financial advisor in the US or elsewhere, you want to speak with them to make sure that they're understanding of Portuguese taxation, to make sure that you're not putting yourself into sort of any tax liable or unnecessary situations. But yeah, Lenny, if you want to sort of reach out to me via email or scan the QR code, feel free to do so. We can have a conversation about this. We can run through your options there. I think that's everything for today. As I mentioned, if you want to speak, any questions, email, book a meeting. More than happy to sit down with you and run through whether or not we can help. Peter, I'd like to thank you very much once again for attending this evening. Have a good evening. I know you're off to the football, so enjoy and yeah, thank you again.
Pleasure. Thanks, Henry. Thank you all for
No
listening.
worries. Cheers, everyone. All the best.